A buyer will benefit a lot more by the seller contributing to their concessions to buy the interest rate down than asking for the seller to take a less of an purchase price on their house.
Now, you did say, though, that there are some limits on how much you can get as a seller concession. I think that depends on the type of loan that they have. Is that correct?
That's absolutely correct. So with our 30-year fixed mortgages for a primary residence and a second home, if you put less than 10% down, then we're capped at asking the seller 3% of sales price towards your closing cost. If you put between 10 and 24.9% down, we can ask for the seller to pay up to 6% of your closing cost. And if you were to put a large down payment of like 25% down, then we are capped at 9% of the sales price.
Okay. And those are conventional loans you're talking about, correct?
That is for the conventional loan, yes. And then the government loans each have their own caps on what the maximum is. On the FHA loan, always the seller can pay up to 6% of the sales price towards your closing cost.
Okay.
Same thing with the USDA loans, a seller can contribute 6% in seller concessions. And then on the VA loan, it is 4%.
So that's pretty good on a VA loan. That's for veterans. They don't have to bring anything to the table, number one, and they can also get a seller concession up to 6% to help buy down the rate, it sounds like. Is that correct?
Yes, on the VA loan, it's a zero. Most the veterans put 0% down and they can get up to 4% sales price towards closing costs. So usually if you can negotiate, then absolutely the veteran needs very little, if anything, out of pocket.
Obviously, this sounds great, but there's got to be some gotchas out there. When would you not recommend somebody doing a 3-2-1, a 2-1, or 1-0, or 1-1 buy down on when they're purchasing a house?
I would not recommend doing a temporary buy down if they don't have the funds to put down, obviously, for the temporary buy down, or if the seller's not contributing. I would not recommend buyers paying for a permanent interest rate buy down if they do not plan to stay in the home for typically 5 years, or if they are hoping to refinance if interest rates come down in the future. The biggest difference between the temporary and the permanent interest rate buy down, one of the great things about the temporary buy down is if we set aside, say, $17,000 to do a 3-2-1 buy down, and rates were to come down in a year, 12 months, and it makes sense to refinance. The money that we didn't use in the temporary buy down, if we don't fully use that 3-year period that we did the temporary buy down, that money that we subsidize that payment, whatever we don't use, that goes to a principal reduction when we refinance the loan. So they don't lose any of that temporary buy down money. Versus if we do a permanent interest rate buy down, what a permanent interest rate buy down is, that is where we are buying the interest rate down for the full life of the loan. So typically buyers might pay up to 3% of their loan amount to buy the interest rate down. In today's market on a conventional loan, if you pay 3 discount points, it would take an interest rate roughly from, say, 6.99% to probably 6.125%. Okay, so it drops the rate about 1% for the full 30 years. However, the cost of that is going to be 3% of your loan amount. So on a $300,000 house, that's a $9,000 cost that you're going to have to pay, or that will increase your closing cost at closing. And it will drop the monthly payment roughly, it depends on your loan amount, but it drops the monthly payment, say maybe $100 to $150 a month, but you just outlaid $9,000. So usually the break-even point on a permanent buy down is usually about 60 months. So if we do a permanent interest rate buy down, typically we want to stay in this loan for about 5 years to recoup that cost that we paid for the lower interest rate.
All right, so it sounds like there's a break-even point on when it makes sense. Like if the seller's paying it, then it doesn't really matter, right? Because it's the seller's money, not your money. But if you're taking money out of the pocket, then you need to really do the math. If you're only going to be in the place a year or 2, or maybe even 3 years, you're going to get those monthly savings, but it's not going to be enough to offset the money you had to put down at closing.